You noticed something was off, but you couldn't put your finger on it. Your favorite YouTube channel, the one you've been watching for 3 years, the one that felt like that one honest friend who actually explains money without trying to sell you something, started feeling different. The videos got slicker, the opinions got softer, the edgy takes disappeared, and suddenly every other video is sponsored by some financial product you've never heard of. You probably told yourself the creators sold out, maybe they got lazy, maybe they got rich and stopped caring. But what if I told you it had nothing to do with the creator at all? What if I told you that the same firms that just spent hundreds of millions of dollars buying up YouTube channels are running the exact same play on Bitcoin, Ethereum, and every stablecoin sitting in your crypto wallet right now? And what if this whole operation, from your favorite finance channel to the future of digital money, was designed specifically so that you would never see it coming? Stay with me for the next few minutes because I'm going to connect dots that most people in finance don't want connected. And by the end of this video, you're going to look at your YouTube feed and your crypto portfolio in a completely different way. You will never unsee this. If you're new here, hit subscribe right now because on this channel, we break down exactly how money power and Wall Street psychology actually work, and we do it without the corporate filter. All right, let's go. My name is Dave, and I need to start with a question that sounds simple, but is actually one of the most important questions in modern finance. What does Wall Street actually want? Not what they tell you they want, not the press releases about democratizing finance or empowering retail investors or building a more inclusive economy. What do they actually want at the mechanical level, at the level of the strategy that gets approved in the boardroom? They want yield, they want predictable, scalable, low-risk cash flow, and more than anything, they want trust. Not because they are warm and fuzzy, but because trust is the single most valuable and most underpriced asset in the entire financial world. And for most of Wall Street's history, they have had to build trust slowly, brick by brick, decade by decade, through branding and advertising and $50 billion in lobbying. But then the internet happened, and suddenly there were these individual creators, these completely independent humans sitting in home offices and spare bedrooms who had built something Wall Street spent a century trying to manufacture genuine, organic human trust. And the moment Wall Street figured out how to buy that trust wholesale, the game changed forever. Here's how it works, and I want you to pay very close attention because the mechanism here is elegant in a way that should genuinely impress you even as it horrifies you. It starts with something called private equity. If you don't know what private equity is, think of it this way. Imagine a firm that raises billions of dollars from pension funds, university endowments, and ultra-wealthy families. They use that money to buy businesses that are not publicly traded. They hold those businesses for a few years, restructure them, and then sell them at a much higher price. That price difference is the profit. It is that simple, and it is enormously powerful now. Private equity has been doing this with boring businesses for decades: laundromats, dental clinics, storage facilities. And it worked great because boring businesses produce reliable cash flow, and that cash flow is easy to value. But here's the thing about boring businesses: they do not come with millions of loyal followers who hang on every word of the person running the operation. They do not come with an audience that trusts the business enough to make major financial decisions based on what the business tells them. YouTube channels do. And when a private equity firm looked at the creator economy and saw a finance YouTube channel with 2 million subscribers generating $4 million a year in ad revenue, sponsorships, and course sales, they saw something extraordinary. They saw a trust machine, and trust machines have a very specific price. This is where I need to explain a concept called multiple arbitrage, because this is the engine that makes the entire thing run. When a private equity firm buys a small business, they often buy it at what is called a 3x to 5x multiple. That means if the business makes $1 million per year, they might buy it for $3 to $5 million. That is the purchase multiple. Now here's the magic trick: when you bundle a bunch of small businesses together into one larger entity, something strange happens to the valuation. A company making $50 million per year is not valued at 3x to 5x. It gets valued at 15x, 20x, sometimes even higher. The multiple expands just because the company got bigger. So a private equity firm can spend $50 million buying 10 small YouTube channels that each earn $1 million per year. Individually, each channel is worth $3.5 million, but bundled together into a media network generating $10 million per year, that network might be worth $150 to $200 million, and it just turned $50 million into $200 million without creating a single new creator, without doing anything except combining things that already existed. That is multiple arbitrage, and it is the entire reason Blackstone and firms like them are aggressively building positions in YouTube networks, podcasting platforms, and creator economy infrastructure. I mentioned Blackstone specifically, and I want to sit with that for a second because firms like Blackstone aren't just pouring hundreds of millions into YouTube networks like Recurrent Ventures. They are building the infrastructure to tokenize every financial asset in the world. We will come back to what tokenization means in just a few minutes because it connects directly to the crypto story. And when you see how those two threads meet, you're going to understand something most investors completely miss. But first, I need to explain what happens to a YouTube channel after private equity buys it, because this is where the psychology gets genuinely disturbing. When a private equity firm acquires a creator-led business, they face what investors call keyman risk. The keyman is the person whose face, voice, personality, and credibility is the entire reason the business has value. In the context of a YouTube channel, the keyman is the creator. The human being viewers actually trust. Keyman risk is a problem for investors because it means the entire asset can walk out the door. The creator could get sick, they could get bored, they could have a public controversy, they could just decide one morning that they don't want to do it anymore. And if they leave, the trust leaves with them. The $50 million acquisition becomes worth almost nothing. So what does private equity do? They eliminate the keyman risk, they restructure the business so the creator is no longer essential. They build systems, teams, SOPs, what the industry calls standard operating procedures that allow the content to keep being produced even if the original creator is gone. They turn the human creator into a replaceable component. They manufacture the feeling of authentic individual voice at industrial scale. And what is the output of that process? The videos get slicker, the opinions get safer, the edgy takes disappear. Every video starts to feel like it was run through a corporate compliance review because it was the channel that once felt like your honest friend is now a product designed to retain your attention while minimizing any risk that might upset an advertiser, a financial sponsor, or a regulatory body. You felt this even if you didn't know what you were feeling. And now you know the name of what you felt, but here's what I really need you to hold on to. The story does not end with YouTube channels. The story with YouTube channels is just the warm-up act. It is the practice run. The real game is so much bigger. Let me take you to the world of cryptocurrency. Go back to 2015 or 2016 for a moment. The crypto space was chaotic and weird and genuinely radical. There were people building financial systems that operated entirely outside of traditional banking infrastructure. There were programmers and anarchists and libertarians and true believers who genuinely thought they were building a new global financial architecture that no government or bank could control. And at the center of all of this was something called decentralized yield. Protocols where you could lend your crypto assets and earn interest rates of 8%, 12%, sometimes 20% or more per year entirely outside of the traditional banking system. No bank account required, no credit check, no FDIC, just code. Now, I want you to think about what that looked like to a traditional banker sitting in Manhattan in 2019. They saw an uncontrolled alternative financial system that was growing faster than anything they had seen in their careers. They saw yields that made their own savings products look laughable. They saw millions of young people moving money out of traditional banking systems and into something they could not regulate, could not control, and could not profit from. They saw a keyman risk problem, except in this case, the keyman was not a human being. The keyman was decentralization itself. The keyman was the crypto yield. The keyman was the entire principle that this system existed outside of their control. And the playbook for dealing with keyman risk is always the same. You eliminate it. Now, I need to explain something called stablecoins because this is where the story gets extremely current and extremely important. A stablecoin is a type of cryptocurrency that is pegged to a stable asset, usually the US dollar. One stablecoin equals $1. The most well-known ones are USDT, which is Tether, and USDC, which is Circle. There are billions of dollars worth of these things circulating in the global financial system right now. In the early days of crypto, stablecoins were used primarily to move between volatile crypto assets without having to exit to cash. They were plumbing, they were infrastructure, they were boring. But then something happened that changed everything. Decentralized finance protocols started offering yield on stable coins. You could hold USDC, which was essentially just a digital dollar, and earn 8% or 10% per year by lending it to other participants in the system. This was yield that no bank in America was offering on dollar-denominated deposits, and people noticed billions of dollars worth of stablecoins flooded into these yield-generating protocols. And for a brief, remarkable moment, ordinary people with ordinary money were accessing yields that had previously been available only to large institutional investors. Traditional banks watched this happening, and they were not happy, because every dollar sitting in a DeFi yield protocol was a dollar not sitting in a bank account. Every dollar earning 10% in decentralized finance was a dollar that made the bank's 0.01% savings account look like a bad joke. So what did? They used the same playbook. They started the process of institutionalizing crypto the same way private equity started the process of institutionalizing the creator economy. Step 1, create regulatory uncertainty, make it unclear whether these yield-generating protocols are legal, whether the yield itself constitutes an illegal securities offering, bring enforcement actions, make the legal risk so uncomfortable that most institutional capital stays out of the space. Step 2, wait, let the market mature, let the volatility shake out the weak hands, let the scams and collapses destroy public trust in the unregulated version of the product. Step 3, come in with the solution. Offer a regulated, safe, institutional grade version of the exact same product, a version that exists inside the traditional financial system, a version that you control. We are currently living through step 3, and the vehicle for step 3 is something called the Genius Act. The Genius Act is proposed legislation in the United States that would create a formal regulatory framework for stablecoins. And on the surface, it sounds like exactly what the crypto community has been asking for. Clarity, rules, a path to legitimacy, but read deeper and what you see is something very different. What you see is a blueprint for bringing stablecoins inside the traditional banking sector, for allowing regulated banks and financial institutions to issue their own stablecoins, for creating a system where the stablecoin market, which is currently measured in the hundreds of billions of dollars and is growing toward trillions, becomes an extension of the existing banking infrastructure. And here's the part that should make you stop and think. If major U.S. banks can issue their own stablecoins, and if those stablecoins are treated as trusted government-regulated financial instruments, what happens to the existing crypto-native stablecoins? What happens to USDC? What happens to the decentralized stablecoins that don't have a bank backing them? They either get absorbed into the new system or they get competed out of existence. And what about the yield? What about the 8% and 10% decentralized yields that drew billions of dollars into the space in the first place? Gone, or more precisely captured, because if banks control the stablecoin market, they control the yield. And the yield goes to shareholders, not to retail depositors. The yield that regular people were earning by participating in decentralized protocols becomes the profit margin of JP Morgan Chase and Bank of America. Do you see it yet? Do you see the pattern? In the creator economy, private equity bought the trust that creators built and then engineered the creator out of the equation to capture the profit in the crypto market. Institutions are buying the infrastructure that crypto builders built and then engineering the decentralization out of the equation to capture the profit. The asset is different, the industry is different, the terminology is completely different, but the strategy is identical. Step 1, identify something people trust that exists outside of institutional control. Step 2, create a path to acquire or absorb that thing. Step 3, remove the element that made it independent. Step 4, extract the yield. This is the Wall Street playbook. It has been the Wall Street playbook for over 100 years. The names change, the assets change, the press releases change. The fundamental strategy never changes. And look, I want to be honest with you here because I think there's a version of this conversation that goes too far and too fast into conspiracy territory and loses the actual insight. Private equity buying YouTube channels is not necessarily evil. Professional management can genuinely improve businesses. Regulatory clarity for stablecoins is not necessarily evil. A system with real consumer protections is genuinely better than a system where scams and collapses happen every 6 months. The question is not whether these processes are happening. They are visibly, verifiably, with public financial filings and congressional hearings you can watch on C-SPAN. The question is whether you understand the second and third order effects, whether you understand what you're trading away when you trade chaos for stability, when you trade independence for institutional backing, when you trade yield for safety, because here's the thing about trust. Trust is not just a soft emotional concept. Trust is an economic asset with real measurable financial value. And when Wall Street buys trust, they are not just buying goodwill. They are buying pricing power. They are buying the ability to sell you products you do not need at margins you would never accept if you were thinking clearly. The finance YouTuber who used to tell you the honest truth about index funds and against high-fee active management now has a very different incentive structure, because now their channel is owned by a firm that has significant positions in the exact financial products that the old version of the channel would have warned you about. And the crypto ecosystem that used to offer you yields that competed with Wall Street's own products will, if current trends continue, become an extension of the Wall Street product suite, the same institutions, the same fee structures, the same information asymmetry, just with a blockchain on the back end so you feel like you're participating in something modern and disruptive. Let me give you a concrete framework for thinking about all of this. I call it the trust acquisition cycle, and it has 4 stages. Stage 1 is organic trust creation. An independent actor, whether a person, a community, or a protocol, builds genuine trust through transparency, honest communication, and results that actually deliver value to participants. This trust is real. It is earned. It is not manufactured. Stage 2 is institutional recognition. Large capital pools identify the independent actor as a valuable asset. The trust it has built represents a significant economic opportunity. Research reports get written. Conversations start happening in boardrooms. Stage 3 is acquisition and extraction. Through purchase, regulation, or competitive pressure, the institutional capital moves to absorb or control the independent actor. Terms are negotiated, deals are made. Sometimes the original creator or founder gets very rich. The trust base is transferred to the new owner. Stage 4 is yield capture. Now that the institution controls the trust asset, it uses that trust to distribute its own products to the audience. The information that once served the audience now serves the institution. The yield that once went to participants now goes to shareholders. The cycle is complete, and here is what makes this so hard to defend against. By the time most people recognize that they are in stage 4, they have already been participating in the system long enough that switching feels like too much friction. Their financial accounts are linked. Their portfolio is structured around the ecosystem. Their community is inside the platform. Wall Street is not just buying your trust, they are buying the switching cost that trust creates. Now, I want to spend the last part of this video talking about what you can actually do with this information because I'm not interested in making you paranoid. Paranoia is expensive. It freezes you. I want to make you strategically aware because strategic awareness is profitable. Here's the first thing to understand. Not all institutionalization is permanent. One of the most interesting dynamics in the crypto space right now is that every time a major institution moves in and starts compressing yields and removing decentralized options, a new wave of builders moves to the frontier and builds something new. The frontier keeps moving. The truly decentralized experiments keep happening. The institutional playbook can capture today's frontier, but it cannot capture tomorrow's, which means the most valuable skill you can develop right now is the ability to identify what is still genuinely independent, still genuinely trust-based, still operating at the frontier before the institutions arrive. And the signal for that is actually pretty simple. When something is inconvenient, when it requires real effort to access, when there is no slick app and no customer service hotline and no insurance guarantee, that is often where the genuine value is concentrated because Wall Street has not gotten there yet. The second thing to understand is information hygiene. You need to be actively aware of who is funding the financial content you consume. This is not optional anymore. The old model where you found a creator you trusted and then trusted everything they told you is no longer safe. The question you need to ask about every piece of financial content is not just, is this accurate? The question is, who benefits if I believe this? That is a fundamentally different question, and it produces fundamentally different answers. For YouTube channels, look at the ownership structure, look at the sponsorship disclosures, look at what changed after a major funding round. The information is out there, and it is not that hard to find. The creators who are still genuinely independent generally make a point of telling you that they are independent. The ones who are not tend to let their content speak for itself and hope you don't notice the shift. For crypto products, look at who controls the upgrade keys, who controls the treasury, what happens to yield when institutional volume flows in. Decentralization is not a binary, it is a spectrum. And understanding where on that spectrum any given product sits is one of the most financially important judgments you can make. The third thing, and this is the one I want to leave you with, is something I call asymmetric trust allocation. Most people in the current information environment are either fully trusting or fully cynical. Fully trusting means you take everything at face value and you end up as the exit liquidity every time the cycle completes. Fully cynical means you sit out everything and miss every genuine opportunity that still exists. The smarter approach is asymmetric trust allocation. You allocate very little trust to institutional products and institutional voices because the incentive structures are legible and they are almost never aligned with your interests. You allocate moderate trust to independent voices with transparent track records and verifiable track records of accuracy. And you allocate high trust to primary sources, to on-chain data, to financial filings, to the actual text of legislation like the Genius Act, which anyone can read. The asymmetry matters because the cost of being wrong on these different categories is very different. Getting the institutional product wrong costs you money in fees and bad products and captured yield. Getting the genuinely independent voice wrong might cost you something, but the downside is limited because the person genuinely had no way to scam you at scale. Getting the primary source wrong is almost impossible if you do the reading. Wall Street can buy a creator's trust. They cannot buy your ability to read a 10K filing or check an on-chain transaction. That is the one edge that is genuinely yours, and they cannot take it. We are living through one of the most significant reorganizations of trust infrastructure in financial history. The internet created a window where genuinely independent voices could build genuine trust at scale. That window is not closed, but it is narrowing. Private equity is moving through the creator economy with industrial efficiency. Regulatory frameworks are moving through the crypto ecosystem with congressional deliberation. Both processes are further along than most people realize, but here's the thing about understanding the playbook. Once you know it, you cannot unknow it. Once you can identify stage 1, stage 2, stage 3, and stage 4, you start seeing it everywhere. In every acquisition announcement, in every congressional hearing about crypto regulation, in every YouTube channel that quietly shifts from honest critique to sponsored content. And once you see it, you can start positioning yourself on the right side of each transition, not against Wall Street, because fighting Wall Street with retail capital is a bad bet. But ahead of Wall Street in the spaces they have not yet reached, in the assets that still carry genuine yield because they have not yet been captured, in the information sources that still carry genuine signal because they have not yet been absorbed, that is the Dave Invest Smart Framework, not paranoia, not cynicism, strategic positioning based on understanding how the money actually moves, because the investors who win over the next decade are not going to be the ones who trusted the most. They are not going to be the ones who trusted the least. They are going to be the ones who trusted correctly, who allocated trust the way they allocated capital, with rigor and with clarity about the incentives of every party in the room. You're now one of those people. If this video connected those dots for you in a way that no one else has, do me a favor and hit subscribe right now, because this is exactly what we do on this channel every single week. We take the things that Wall Street hopes you never understand, and we explain them in plain language until they make sense. Share this video with one person who you think is consuming financial content without understanding who is really behind it, because that conversation matters, and it starts with understanding. This is Dave, and I will see you in the next one.